Thanks so much for tuning in to yet another episode of Navigating Through Uncertainty. We've been speaking to some terrific minds over the last 3 episodes to try and give you a sense of how you as an investor can navigate through the uncertainty currently and the uncertainties that lie ahead. And a very, very special name joins us today. So the next 20 minutes, you want to hear everything that he says with proper attention, because it'll be really, really important to get the views of Christopher Wood. He joins us right now. He really needs no introduction. Chris, it's been a while that we've had you on BloombergQuint. Thank you so much for joining in. I hope all is safe.
Yes, thank you.
Yeah, Chris, I know COVID is front and center of everybody's mind, but I want to borrow a couple of lines that you've used in your 15th April Greed and Fear report to talk about the thing that might be a global issue, if at all, and that's inflation. Now, you mentioned, Chris, in the note that during the interim period, investors should continue to keep a close eye out on market-driven inflation expectations, as you've discussed on several occasions. My question is, are you saying that it is not what the Fed and the central banks will do, but what the market expects them to do, which will drive the sentiment and thereby markets in the near term?
Well, my view since the start of this calendar year is that the most important issue for markets this year is how the Fed will react when it becomes clear that the cyclical rebound out of the pandemic is probably greater than what they're expecting, and also the potentially inflationary pressures. Because my view has been that there's potential for a huge triggering of pent-up demand. And actually, since the beginning of the year, we've clearly had US growth forecasts going up strongly because of the very strong data being reported. So to me, the strong growth is a positive. The vaccine rollout in the US is positive for cyclical optimism on the American economy. But monetary policy remains incredibly easy. So the risk to markets is quite clear. That is any hint of monetary tightening out of the US. But the Fed wants to remain dovish. So I'm saying that before we get any monetary tightening or tapering scare, it's likely to be preceded by rising inflation expectations. So if inflation expectations are not rising, then markets can relax. But inflation expectations have been rising this year, but they've not yet risen to the level that could trigger a monetary tapering scare or trigger a change in Fed policy.
Yeah, with the presumption, Chris, that the Fed stays accommodative, but the yields move up gradually over the period of the next 3 to 6 odd months or 9 odd months, will that pose a problem, or do you think the market will digest a gradual up move?
No, to me, the market, I basically have a constructive bias towards equities so long as the Fed is not tightening. And in my view, the question for equities is less the overall direction, is whether you own cyclical growth stocks or growth stocks. So in the last couple of quarters, I've had a bias in favor of cyclical stocks simply because of the reopening trade. And that obviously has worked, but by the end of last quarter, the view that cyclical stocks were the place to be had become consensus. So we're seeing the market go the other way so far this quarter in terms of growth, outperforming cyclicals again. But I would be surprised if there's not another run in the cyclical stocks. And my view is that a sell-off in the stock market triggered by a tapering scare is more likely to happen after treasury bonds have sold off more and cyclical stocks have rallied more.
Okay.
But the Fed does not want to tighten. The Fed is trying to stay dovish.
Yeah, most certainly. And I think they've kind of Jerome Powell has spoken about it a number of times on so many occasions. Yeah, just one more follow-up, Chris. And again, I'm borrowing a line that you've used in your Greed and Fear note. And I think you've mentioned that you've shown a chart as an exhibit which shows that there is a potential for a massive allocation from bonds into equities if inflation does return back. So quite conversely, while the market might fear a return of inflation, you believe that might actually usher in a movement away from bonds into equities, which might actually be positive.
Well, from a relative performance standpoint, if inflation really starts to come back after we've been in this disinflationary trend since the early 80s, there's absolutely no doubt that equities will outperform bonds. I mean, equities may not do that well in real terms, but they will definitely be much better for preserving capital than bonds. But whether inflation is really coming back remains unproven. What I've been saying is investors right now should be prepared for an inflation scare. And then whether this turns out to be a long-term turn in inflation or not will depend on how the central banks, particularly the G7 central banks, and in particular the Fed, respond. Because if the Fed stays extremely dovish, if the Fed locks in bond yields, for example, by implementing some form of yield curve control, that would definitely increase the odds that inflation is turning up. Whereas with conversely, if the Fed suddenly turns orthodox, admits that it's been too easy, and starts meaningfully contracting the balance sheet, then there's a chance that the deflationary trend reasserts itself. That's why it's very important how the Fed responds. But my base case is that the Fed remains dovish. And the longer they remain dovish, that creates potential for a regime shift from a deflationary world to an inflationary world, because we have had the most extraordinary level of monetary and fiscal stimulus in America since the pandemic hit. And the rate of growth of broad money supply has been enormous.
Yeah, that's true. And so much of it is found its way into risk assets. Chris, in which case, what is the overarching risk or the overarching trigger for equities over the course of the next 6 to 9 odd months? If it is not Fed, presuming that the Fed will stay on course, what is it that you would watch out for?
Now, the biggest risk to equities, without a doubt, is not the Fed. It's sudden evidence that these vaccines have no efficacy. That is the biggest risk. That would trigger a massive bond market rally. Otherwise, to me, the biggest risk is simply a sudden realization by the Fed that they're too easy, and the market suddenly having to discount a much more dramatic tapering process than currently. Currently, the market consensus, which has been encouraged by the Fed, is they will maintain their level of bond purchases throughout this calendar year, start a very gradual tapering process at the commencement next year, which will go on to the end of 2022, and that they won't raise rates until 2023. But to me, a more interesting point is in the course of this event, I think the doves on the Fed will want to do yield curve control, lock in bond yields. If they do that, that would signal that they really are very serious about bringing inflation back. We already have yields being yield curve control in Japan, and the ECB currently appears to be targeting nominal bond yields too. And when governments start to target or hold down longer-term government bond yields, that basically is a regime of financial repression, and that, in my view, is much more likely to end with an inflationary outcome. Because if a government formally targets bond yields, the central bank formally targets bond yields, then they are committing themselves to potentially unlimited balance sheet expansion.
Yeah. Can I just squeeze in a non-equity question in between? What does this mean for other asset classes, therefore, gold, crypto, what have you? And there are multiple variable factors around this, but I think you've written a bit about all of these. Can you speak a bit about that?
Well, yes. Well, gold has been under a bit of pressure this year, which is not surprising because we had a cyclical. We've had growing expectations of cyclical recovery, and we had U.S. Treasury bond yields rise by significant magnitude last quarter. And gold is very sensitive to the level of real interest rates. So gold in US dollar terms trades around the direction of real rates in the US, be it 3-month or 10-year. So it wasn't surprising to see gold come under pressure. But my base case at the start of the year that was gold was at risk of correcting to 1750. It got a bit lower than that. Now, if bond yields start rising again in the US, gold will be vulnerable. But if the central bank, the Fed, at some point tries to block bond yields, then it will be extremely positive for gold. But I also think gold now has competition as a store of value trade from crypto. And millennials, in my view, I don't think gold and crypto are mutually exclusive. I think Bitcoin is a competitor to gold, but they're basically not. You can own both. But the practical reality is that millennial investors are much more likely to buy Bitcoin than gold. And the other practical reality is that Bitcoin has been massively outperforming gold. So I think it's risky to only have all your eggs in a gold basket, because Bitcoin is tried and tested. It's withstood two massive bear markets. It's been around long enough for now that I'm assuming it's not going to go away. And Bitcoin actually has a more positive supply dynamic than gold because of this halving process. And we had a halving of Bitcoin last year, and after the previous halvings, you had very big gains in Bitcoin. So my base case is that this Bitcoin rally will continue. And the other big driver of the Bitcoin rally is the institutionalization. You're getting a developing institutionalization of Bitcoin, because over the last 6 to 12 months, it's become possible. Custodian arrangements have been put in place to allow institutions to invest in Bitcoin.
Got it. Am I to presume that Chris Wood believes Bitcoin should be a part of portfolios?
No, I formally introduced an allocation in my global portfolio for a pension fund in Bitcoin in the middle of December. The reason I did it then was because it became possible for institutions to invest in Bitcoin. Whereas I would say a year and a half ago, that was not the case.
Got it. Okay. Okay, let me try and focus a bit on India, Chris. Now, the world is probably not looking all that bad. India, for fairly idiosyncratic reasons and maybe reasons which are can be equated to maybe 2 or 3 other countries, but is looking particularly slightly tough. My question is, Chris, while yes, we are in the midst of a really big COVID nightmare, so to say, other economies have gone through such a period, right? I remember December and January, UK went through a terrible time. NHS was bursting apart at its seams, and they had a lockdown, which India doesn't have. So how bad is this situation looking for India, considering that governments have not shown the inclination to lock the economy down, so to say?
Yeah, well, I personally think that the lockdown last year in India was counterproductive, because to me, it caused huge collateral damage in the economy, which would have caused huge hits for federal human welfare. You have many people operating on daily wages, so I don't think national lockdowns are practical in the Indian context. And I personally, my guess is that the government, the national government in India, has formed a similar view, because all the evidence is they're extremely reluctant to impose another national lockdown. Personally, I think that's absolutely correct, and they're leaving it to the states. So amidst the horrific news flow, because clearly in the middle of March, many people in India were hoping that the COVID had peaked. So the fact that they haven't locked down, I think you can see in the stock market. The Indian stock market has not corrected much relative to the news flow. So and I think that reflects the expectation of investors that there won't be another national lockdown. But the key question in India, clearly the vaccine rollout will accelerate. What we don't know is the new variants, whether the vaccines have efficacy against these new variants. And we're not going to know that for some time. But to me, one of the problems for emerging markets, especially with the tropical climates, with this vaccine rollout, is that the new technology vaccines like Pfizer and Moderna, which are most easily tweakable for new variants, require sub-zero temperatures. And so there's assuming you can even afford these vaccines, there's a practical problem administering these vaccines at scale in countries with tropical climates.
Agreed. So therefore, but Chris, my larger question is, if indeed at what is seeming like the peak of the despair around COVID in India, if the economy is not locked down, then would the economic impact of the current wave be as severe as in the past, and
Maybe,
therefore,
my opinion, be nothing like it's severe.
it won't be. So therefore,
Yeah.
what's the impact on the markets? The reason I asked this also, Chris, because I noted a note that you wrote some time back, wherein, for example, on cyclicals like banks, you did a double downgrade, right? From an overweight, you moved to an underweight in banks, citing
No,
these
but
as
no,
reasons.
I did that when the lockdown happened. I was very bearish on India when this national lockdown happened because I thought it was totally the wrong policy. I'm talking about last year. So
No,
this year, I'm feeling. This year, yes, I'm feeling more constructive precisely because a national lockdown has not been implemented, because I viewed the national lockdown as completely counterproductive. Now, the interesting point, so all I did at the start of this quarter, because I'd raised my weighting a lot in India in the last 6 months, as it became clear the cyclical recovery was happening, as it became clear that the bank, the percentage of restructured loans in the banks was less than we were fearing. That was a reason to add money to India. Many foreign investors did the same. They reduced China and added to India because China recovered first. I did the same thing. That made sense as a trade.
Of course.
But at the beginning of this quarter, when we saw the COVID cases rising, what I did is I reduced my overweight in India. But I'm doing asset allocation on a 6-month view. If I was doing asset allocation on a 2-week view, I would have removed all the stocks in India. So the key question right now is the stock market has not declined very much relative to the nature of the news flow.
Right.
So to me, that reflects investors' hopes that there won't be a national lockdown. Foreign investors have turned net sellers month to date, I believe, in India.
Yes.
But there was huge buying. In fact, there was record buying of Indian equities fourth quarter last year. So we clearly have risk of more of a correction. But for somebody who doesn't own India at all, this whole setback is an opportunity to buy stocks they should have bought fourth quarter last year. And meanwhile, you've had this very positive pro-growth budget in India. So at the first 2 years of this government, there was concerns among investors, including myself, that the government was prioritizing the social agenda over the growth agenda. I think right now, investors are much more comfortable that the growth agenda is being prioritized.
Okay. Well, so Chris Wood, can I ask you, you mentioned that from a global perspective, you believe that cyclicals will probably score over growth, so to say, if I'm loosely putting it. Do you reckon in India, the domestic facing cyclicals will actually, I mean, are they the pocket to bet on currently?
Well, actually, frankly, the only thing that matters right now in India is to monitor the daily cases, literally daily basis. And that's what matters most. And the second issue is whether the government will stick to its current stance, which is to leave it to the states and avoid national lockdowns. But clearly, a lot of this has become political in India. A lot of the reporting in the Western media is kind of political in nature. So, yeah, so there's a sort of political dialogue going here as well as a dialogue about COVID.
Okay.
But personally, my personal opinion is the central government is absolutely correct to avoid the national lockdown. It makes much more sense to leave it up to the people. And I think that, you know, the Indian data in the second quarter of last year, I think was worse than any other country economy I'm aware of. In terms of the scale of contraction in real GDP growth, nominal GDP growth in India in the second quarter of last year when the lockdown happened.
Sure. So Chris, okay, I'm just trying to understand from you because
so I haven't reduced my weighting in India more than what I did at the start of the quarter. So for me, the issue is when do you add back?
Okay, and that the
I'm assuming there's no national lockdown. If I'm wrong and there's a national lockdown, I should have cut the weighting more.
I get your point. But if there isn't a national lockdown and if the vaccination drive is seemingly successful, then you would reckon that there is a probability that Chris Wood may add back his.
No, absolutely. But my key message to foreign investors who may not have bought as much of India as I would have done in the second half of last year, because when India rallied, it rallied very quickly. as you can
Yes.
see, this is an opportunity to add to what you didn't buy last year. That would be my main. And I think one should assume, until proven otherwise, that the vaccines have some efficacy against these new variants, because that's but there is a practical problem of rolling out vaccines in emerging markets on the scale because of the large population. This is just but I personally think that India can do it quite more effectively than many other developing countries. And we also need to remember that India has one big advantage over many other emerging markets, is that India has the vaccines.
That's true.
I mean, India manufactures the vaccines. That's a big difference than many other countries in Asia.
Yep, and which is why we are hoping, Chris, that the vaccination drive goes off smoothly. I mean, the phase 2 of the vaccination drive, so to say. Chris, one quick word on the non-equity side. The Central Bank of India has been right at the forefront and has probably done a very good job. I wanted to understand your view there. And part 2 of my question, Chris, is this belief that there is there's this talk of this global bond inclusion, which might come to the rescue of the Indian bond markets. Would you believe?
Well, yeah, to me, because the policy in the G7 world has been very, has not been friendly to bond investors. If you, this very aggressive monetary fiscal policy in the G7 world doesn't really give you huge investor confidence you own bonds. Whereas, yeah, policy in India, well, policy has been most conservative in China, which is why I've been recommending Chinese bonds to global investors. My formal recommendation since the end of March last year has been for investors to sell all their G7 government bonds and buy Asian government bonds. I have 60% weighting in the Chinese 10-year in my global sovereign bond portfolio, and I have a 20% weighting in the Indian 15-year. So to me, the Indian bond market is reasonably attractive on a relative basis, and yes, I think there's hope that India will start to be included more in the bond indices like China has been. And if India is included, that will definitely open up more capital inflows.
Okay. And you reckon the Indian Central Bank has ticked all the right boxes, Chris? Anything that you would expect the central bank to do more?
Well, I think the central bank has been, got it right. Obviously, you're the Indian Central Bank. Credit growth slowed sharply last year in India. So in that environment, it doesn't make sense to worry too much about inflation because you've got a sharp slowdown in credit growth. But obviously, you've got rising food prices in many parts of the world. The lockdowns, I think, last year aggravated food price inflation in India. So that's another reason to be wary of lockdowns. But ultimately, it's very hard for central banks to manage food prices. Yeah. Because that inflation is not a monetary phenomenon. And that's why it may make sense I believe the RBI's target is headline inflation. But in that sense, it may make more sense for the RBI to look at core inflation. But I've got no issue. I'm not criticizing the Indian Central Bank. I've got, as I say, I have a 20% weighting in India in my global sovereign bond portfolio.
Got it. Chris, one final question, and that's a bit on the micro, because you write a lot of Indian micro as well in your notes. You've been a long proponent of real estate in India. You just told me that you're not negative banks. If anything, you're positive cyclicals. Can you tell us the current stance, presuming, of course, that everything goes as per plan?
Well, the property market was definitely, based on what the data I've seen from my colleagues in India at Jefferies office, clearly the property sector was really looking like it was finally turning after this multi-year bear market. You've had massive consolidation in the developer space because of all these policies, be it RERA or DMAN or GST. So huge. You've had a massive consolidation in the property sector I've seen in any economy in my life, actually. So that has to be a long-term opportunity for the developers who've survived the consolidation. Clearly, we've now got another setback cyclically with what's going on. But to me, the property market is the obvious area to act as a multiplier for the economy and generate employment. But yes, so to me, but I think if you're going to, and I'm telling foreign investors still, if I'm owning one or two core sectors in India and I'm not a specialist, the core sectors have to really be things like private banks and insurance. They're the long-term growth stories. Property is interesting, but it's obviously a little bit more, it's a more high beta.
What about global cyclicals, Chris? Finally, I mean, the metals, the IT companies.
No,
I mean,
personally, I think there's a, you're getting pushback on this view, but I would be surprised personally if the cyclical rally is over.
Got it. Okay.
Because I still believe that the US, the pent-up demand can be huge in the US. I'll just end with one statistic. American households are, the data shows, have been financial beneficiaries of the pandemic because they've received more money in handouts than they've lost in income. So, and a lot of this money, a lot of this demand is pent up because they haven't been, they're really now being allowed out to spend. So I think this is why demand can really surprise on the upside as you come out of this pandemic. The big risk, to my view, is vaccine efficacy.
Got it. Okay. Chris Wood, thank you so much for taking the time out and speaking to us, and stay safe.
Thank you very much. Thank you.
Pleasure is ours. And viewers, thanks for tuning into this edition of Navigating Through Uncertainty.